The S&P 500, a perpetual dance with all-time highs over the last 3 years, tells a tale of resilience and recovery. A significant rally in 2023 managed to mend the wounds inflicted in 2022. One prominent star in this celestial market show is Nvidia, catapulting its market cap from $300 billion to an astronomical $1.2 trillion. The driving force behind this meteoric rise? The AI revolution, a crescendo in demand that reshaped the company's destiny. Yet, this financial euphoria is not without its shadows. Market sentiment, once driven by fear, now wallows in the depths of extreme greed. A change so drastic that it raises eyebrows, prompting one to wonder if the pendulum has swung too far. The anticipation of rate cuts in 2024, riding on the perceived success of Jerome Powell in engineering a soft landing, fuels this greed. The expectation is clear: lower interest rates to prop up the economy, providing rocket fuel to risk assets. Speaking of risk assets, they are on a rebound. The prospect of lower interest rates acts as a balm, healing wounds inflicted by economic uncertainties. ETFs tracking 7 to 10-year Treasury bonds witnessed a spectacular rally in the closing months of 2023. However, a 5-year retrospective paints a less exuberant picture, with total returns teetering around break-even, dividends included. Simultaneously, the media finds itself in a precarious position. Trust, a currency traded with the public, has been eroding for decades. The rise of deep fakes, facilitated by advanced AI technology, exacerbates this decline. A cacophony of misinformation and manipulation strains the very fabric of our information ecosystem. As we navigate these turbulent waters, the siren call of interest rates beckons. Cash yields soar over 4.8% at Interactive Brokers, raising eyebrows and, more ominously, concerns. The specter of Ponzi financing looms large, a shadow cast by the burgeoning debt levels in the United States. It's a high-stakes game, and the question of sustainability echoes through the financial corridors. Turning our gaze to banks, despite the uptick in interest rates, delinquency rates on commercial banks hover near all-time lows. A perplexing scenario that raises eyebrows and, in some quarters, sparks anticipation of impending problems when loans come due. It's a delicate balancing act, and the potential for turbulence is not lost on those who watch the financial tides. On the global stage, economic challenges cast a shadow over the current rally in Treasury bonds. The lack of leadership addressing the unsustainable trajectory of U.S. debt adds a layer of complexity to an already intricate puzzle. Gold, that perennial hedge against uncertainty, approaches all-time highs. Some interpret this as a signal, a subtle warning that central banks may be losing control. The speculative whisper of potential inflation or looming economic troubles adds a note of caution to the financial symphony. In the face of these uncertainties, our investment approach takes a grounded stance. A bottoms-up methodology guides our decisions, emphasizing individual company fundamentals. Growth, cash flow, and potential valuation expansion become the compass points in our financial journey. The clarion call is for a long-term, rational approach that withstands the capricious whims of short-term volatility. Yet, caution is the watchword in an environment marred by extreme greed. The higher hurdle for excitement in new investments is a conscious acknowledgement of the frothy waters we navigate. The call to stomach inevitable 50% declines echoes through the chambers of financial wisdom. Long-term success, it asserts, springs from an understanding and tolerance of volatility. Amidst the uncertainties, there is a glimmer of opportunity. The prospect of buying more if holdings drop by 10 to 50% hints at a contrarian strategy, a willingness to swim against the current. The slow and deliberate approach to stocking favorite holdings over time, adding cautiously on the ascent, and seizing opportunities during sell-offs paints a portrait of resilience and patience. In conclusion, the financial landscape, while painted with the vibrant hues of success, is not devoid of shadows. The interplay of market forces, geopolitical uncertainties, and technological advancements creates a complex tapestry. Our journey demands a strategic and measured approach, a recognition that success is not a sprint but a marathon. As we navigate the undulating waves of the financial sea, the key lies in vigilance, adaptability, and the unwavering commitment to the principles that guide us through the storm. Please consider liking, subscribing, and sharing with friends to support our content. The information is for general purposes. Viewers should conduct research and consult professionals for financial decisions.